Hello, everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Darrell Thomas, and today we have the pleasure of interviewing Matthew Piepenburg. Welcome back to the show.
Well, Darrell, it's great to be back and looking forward to coming to the VRIC or the VRIC conference at the end of the month. So gosh knows there's plenty to talk about in the meantime, but it's great to be back.
Yes. So what are some of the things you're anticipating coming to the conference this year?
Well, I mean, look, the more things change, the more they stay the same. I mean, it's 25 looking back was obviously just an extraordinary year for precious metals. That goes without saying. And there's been a great deal of geopolitical and financial headlines throughout the year and starting into this year. So there'll always be something new in the headlines to talk about and put into context, which is always important. But I think there's so much noise and so many headlines and so many changes. But the backdrop and the setting for precious metals and gold and silver obviously started decades ago when we went off the gold-backed currency and we had an unchaperoned world reserve currency that's becoming less and less trusted for manifold reasons. And again, those are the headlines, and they change every quarter, every month, every day. But it kind of just reflects a trend, which is hard to quantify. And John Rubino talks about this horizon of distrust in just about everything, from governments to policies to currencies to central bank policies, et cetera. And they're just culminating now after decades of misuse of a weaponized, debased and distrusted world reserve currency, and all the cracks we're seeing in credit markets and geopolitics, central bank policies, inflation, deflation, dollar strong, weak debates. All of these things are important, and we can spend hours on any one of them. But what we're really seeing is just the slow demise of a hegemonic power and a hegemonic world reserve currency, my country's currency, my country's hegemony. It's changing since 1971 in the course of my life. We're experiencing a reckoning of debt gone too far and monetizing that debt with mouse click money gone too far. Look, when you see gold at these numbers, I mean, today it's what, 4,400, silver 75. It changes every 10 minutes, but the secular trend is pretty obvious. When you see charts in the last 2 decades, just sticking back, take a deep breath, just look at the gold and silver charts today. What is it, January 6th? Just look at the charts. It's obviously exciting and somewhat nerve-wracking even for precious metal investors, long-sighted, long-term thinkers who don't look at gold and silver just as a trade, but as a real store of value and a real money asset. But even for us, Rick Rule, Egon, myself, we've always said, I'll be afraid when I see gold move this high. It's great for our bottom line and our top line and for investors who've been way ahead of the curve. But when you see precious metals rising like this, when you see the Comex at 100% delivery this summer, its average is 1%. When you see the LBMA markets in London seize up in October, because of this demand for these monetary metals, again, fantastic for the far-sighted stackers of the world, so to speak, and great to be, quote unquote, right. We're not a broken clock. Gold and silver have outperformed. Gold certainly has outperformed the markets last year, silver too, but gold's outperformed the S&P for the last 25 years. So this is nothing I told you so. This is nothing to brag about or even to get excited about in some ways, because when you see metals rising at this speed exponentially, that means there's lots of problems in the world. There's lots of problems in the global financial system. There are lots of problems in the global currency system. And so, yes, it's exciting. Yes, it's headline breaking. Yes, it's interesting for us who've tracked it. But for all of us who've tracked it and who are benefiting from the rise in these prices, we've said for years, be careful what you ask for, because yes, we're right. I think we're confirmed right for now, at least, that these metals matter. But that means the rest of the world around us is suffering at extreme levels. And when the world is suffering and when the world is desperate, especially sovereigns like the US and the EU and the G7 or the G20, when their monetary systems are breaking down, as they clearly are objectively, this isn't gold bug sensationalism, when they're breaking down, that means things are getting more risky for all of us, whether it's inflation, deflation debates, or whether it's the drumbeats of war and desperation masquerading as some type of freedom or policy excitement or headline kind of GI Joe moment, we're actually in a very dangerous setting, and that's nothing to gloat about, and that's nothing to really be smug about, and that's neither left nor right. That's history, and I'm concerned. I think a lot of us in this space are concerned about the world. We're not necessarily concerned about our balance sheets right now with our long-term views on gold and silver, but the world we live in, the world we're all journeying through together is looking pretty crazy.
Yeah, for sure. I do want to dive into the Comex here in a little bit because there's obviously some action there. I want to get your perspective on, do you think many people are still not awakened to like the nature of this? Because I'm thinking about, President Trump announced yesterday that they're increasing the military budget by another $500 billion, and gold and silver, flat to down today. And it's like, okay, this is actually what should be fueling like the metals, right? I mean, they've ran significantly, but like increasing the military budget and not balancing the budget and not, and we're still operating at a deficit and such. And, the tariff revenue, I mean, I think that even erases the tariff revenue for the year. So I'm just curious, your thoughts there.
Well, look, in the long run, gold and silver, gold in particular, and we'll talk about silver too, but gold, it's just a more honest asset. It's more honest than the headlines. It's more honest than the Comex and LBMA price moves. It's sad, again, to see this trend. I mean, war and the threats of war and the drumbeats of war are always going to be good for gold. But again, I'm not going to be happy to see my gold portfolio ripping further north over the next year or two just because there's more war in the world. There's a point where you'd like to see calmer policies and better senses prevail, but I don't think that's where we're at right now. To your point, though, about war, again, this is something I've talked about for 6 or 7 years, but it's worth repeating so many times. And it's not from Ben Bernanke or, Mario Draghi or Janet Yellen. It's not from, a major president, left, right, or center. It's from Ernest Hemingway in the 1940s, who certainly didn't have a Nobel Prize in economics. But, he was a veteran of the First World War. He was a journalist during the Second World War. He has his faults and greatnesses. But he said something that I've never seen a central banker admit or a policymaker admit. And it was very simple. Whenever you get in a scenario where you're in major debt, unsustainable debt, like Europe is, and they're also talking about military budgets, and like the U.S. objectively is, it's unsustainable. Our public debt, our combined public, corporate, and household debt are at absolute unprecedented levels and unsustainable levels. When you have a country in debt or a system in debt, you'll always get some temporary prosperity because that debt will be monetized by the mouse-click money. That mouse-click money creates inflation and asset bubbles. So you'll get a temporary prosperity. We've certainly seen it in the S&P, the Dow, the NASDAQ, AI, NVIDIA, et cetera. But that's always followed by the permanent ruin. This is what Hemingway said, but I stick to it. The permanent ruin of currency debasement and war. And what do we see in the last few years making higher and higher headlines every quarter, every month, every week? More proxy wars, more inflation discussions. And again, we can have deflation through a market mean reversion or a recession, whether that's induced by AI or interest rate spikes or whatever needles can break these bubbles. We could debate all day. But the major concern for my clients and family offices and high net worths is inflation and war. And certainly in Europe, where I'm at now, in the US, where I've grown up in, war is becoming romanticized now as a policy solution. I think Hemingway was right. I think it's a sign of desperation. I don't think the wars, and again, I'm not here to give a partisan rabbit hole debate. There's guys like Douglas McGregor or Jeffrey Sachs or John Mersheimer who know this far better than me. But I don't think it's a coincidence that we find ourselves in more hot wars, proxy wars, indirect wars as we're getting more and more in debt, as our currency is less and less trusted, and as our policies are less and less believable. This sadly is unique to the headlines today, but in the grand arc of history, this is nothing new. Currency debasement and war are the symptoms of empires in their fourth turning or in their last chapters. It doesn't mean the end of these empires or the end of the U.S. empire, but it shows a desperation that it's no longer the empire it was that I was born into, that you were born into. These changes aren't, to me, heroic. They're desperate, and that's neither left nor right. I don't want to get into a rabbit hole of Trump or the US and what my views are on Israel or all these things. They're crazy. You just create so much tension. But I think this is a war for resources, not a war for freedom and democracy. I think that was true in Syria and Afghanistan. And I know a lot of veterans who fought in those wars, who lost limbs, and friends in those wars who are under constant therapy from those wars, and they'll say the same thing. And they're true. Again, I've always said those are the lions being led by donkeys. They're far more heroic than a Wall Street veteran or a gold executive. I mean, but they're telling me the same thing. This is madness. So I have a lot of friends and family who are veterans. It's nice to wave the flag. It's certainly nice to think we're fighting the drug problem, which is a real problem. But stepping back, for me at least, this is just my bias and my cynical view on history. What we're doing is a sign of desperation. And I think it's kind of like the guns of August. We're in a nuclear era now. We have to be far more careful about puffing our chest because we're broke. And I think we are broke. I think objectively we're broke. I think our currency objectively is distrusted. It was weaponized in 2022. There is de-dollarization. There is a distrust of the US dollar and the US 10-year, the US Treasury. That's why we've seen de-dollarization. That's why we see central banks stacking gold. That's why we see all the symbols we could talk about. The petrodollar to Comex to central bank gold stacking to de-dollarization. These are all symptoms and signs that the U.S. in 2025, 2026 isn't the U.S. it was in 1944 at Bretton Woods or in 1971 when Nixon welched on the gold standard. We are in a fourth turning, and it's sad for me to see the flag being waved in this way. We're acting like 18th or 19th century England, like an empire. We're looking to create new flagpoles in new parts of the world, when I don't think that was the founding interests of our founding fathers, however flawed they were. We were not supposed to be an empire. We were supposed to stay within our own borders, fix our own country, make ourselves great again, but not at the expense of what looks to me like semi-imperialism. And again, that's going to upset a lot of political views that are different than mine. That's fine. But I get away from the politics. I get away from left or right, Trump good, Trump bad. Certainly I wasn't a fan of the Biden administration either. I think, as I've said many times, Santa Claus can't fix our debt problem. So I don't care who's in the White House now. It's simply not solvable. We're past that Rubicon. But to see us moving this way is disturbing. And it'll be interesting to see, like Douglas McGregor and others in Vancouver at the end of the month, get their views on this. So again, I think I have no right to give geopolitical advice, but I think in the context of economics and markets, what we're seeing here is nothing new. It's quite a familiar pattern, sadly.
Our project is right in the southeastern corner of Wyoming. In the space of 4 years, fully engineered, fully permitted.
The ASIC is what caught my eye, $937 per ounce.
110,000 ounces per annum. First year of production is the most impressive. 132,000 ounces of gold, 24 million pounds of copper. You really want these things front-end loaded like that. US Gold Corp is a near-term, low-cost gold producer in Wyoming. To learn more, go to usgoldcorp.com.
I'm thinking about the Fed this year. I mean, obviously, we got multiple things. Like the Supreme Court is going to be ruling on the tariff soon, so we'll see what happens there. If they rule against it, I'm kind of trying to figure out, okay, what kind of rabbits you come out the hat then. Yeah. But then you have this dynamic of the central bank is going through a major shift. They've been cutting rates. They've already pivoted from quantitative tightening to non-QE. But if it quacks like a duck, it's a duck, right?
Yeah, exactly.
But and then also Jerome Powell is going to be stepping down and being replaced soon. And so one thing that I've been reading. So I've been reading some of Dalio's work, Ray Dalio, and he talks about when the Fed starts to backstop the government, for the government spending and financing their deficits, then you're getting into like danger territory and when countries go broke and go bust. And so just curious on your perspective on the Fed moving forward and for this year.
Yeah, it's certainly an important question. There was an economist in the 70s named Charles Goodhart. Nobody really reads him or talks about him anymore. He talked about whenever you politicize anything, whether it's CPI data, whether it's recession data, whether it's employment data, whether it's interest rate data, it's usually politicized data, which usually means it's dishonest. In other words, when you politicize anything, it becomes less transparent and more desperate. I think, the Fed is supposed to be an independent body. I mean, I could spend hours on the Fed. The Federal Reserve is neither federal nor a reserve, if you really break it down. It sits on Constitutional Ave, but its very presence is a violation of Article 1, Section 8 of the Constitution. Our founding fathers never wanted a central bank, an independent central bank, to have control over our money supply or the cost of money. And Woodrow Wilson, right before Christmas, signed the Fed into law. I think that's the starting point of the end of the U.S. Ideology, the U.S.'s founding fathers' warnings. If you don't have a gold-backed currency, you'll eventually destroy the currency. So I'm against the Fed from its very inception. I think Woodrow Wilson destroyed this country in 1913. Again, much longer story. That's the great book, Creature from Jekyll Island, which I recommend anyone read, whether they agree with me or not. It's a fascinating read. But the Fed in and of itself is a problem. When I was in law school, we did a lot of courses on the politics of the legal system when FDR stacked the court in the 30s to really create what was supposed to be an independent legal system. It was really very politicized. As Justice Frankfurter said, you can't forget as judges what you know as men. There'll always be a bias, even in the Supreme Court. You can take the 8th Amendment on cruel, unusual punishment, and you can decide whether that applies to the death penalty or not, depending on your bias. You can twist the Constitution however you want. I think the same thing is true of the Fed. You can put in a hawkish or dovish puppet in the Fed. You can make a decision in the Fed, but the Fed will become politicized. It's not independent. It's very dependent. It's very entrenched in our system. It is a fourth branch of government in my mind. It's not independent at all. It is the exact opposite of what our founding fathers wanted, but the Fed has more power in D.C. than many other branches of government, in my opinion. So to your question, whoever comes in to replace Powell, it won't matter. Even if Powell stayed, it won't matter. They don't have a choice at 38 trillion and counting in public debt to do anything extremely hawkish by raising rates or not having more QE or QE non-QE. They have no choice because there isn't enough natural demand for our U.S. Treasuries without the Fed buying them. The only way the Fed can buy them is literally to mouse click the trillions out of thin air, the billions or trillions out of thin air, to buy our U.S. Treasuries and to keep their yields down. Because if we don't keep those yields down, rising yields are like shark fins. That means higher rates. That means the cost of Uncle Sam's bar tab gets more expensive. So this dovish and hawkish game we play and speculating on what the Fed will do or what Powell will do is, to me, really specious, because at the end of the day, at these debt levels, we don't have a choice but to be dovish because we don't have any other buyers of in a meaningful way, any meaningful buyers of our debt. And since we outsourced the American dream to China in 2001 during the World Trade Organization under Clinton, we said we were going to have China buy all our widgets. What happened is U.S. manufacturers outsourced our labor to China, and the USA now has to import our own products from China. In other words, we outsourced the American dream to China. China and Japan are not buying our treasuries for a lot of different reasons we can talk about. But long story short, who's going to buy our debt? Since we no longer manufacture at home, since we no longer have GDP or a P in our GDP, since our growth is entirely based on debt, and since our deficit and spend mentality since 1971 has gone exponential, and since we're not manufacturing, and since tax receipts and GDP mathematically will not buy our own debt, we're going to have the Fed buy it for us, and the only money they have to do that is a mouse clicked out of thin air. So that is a dovish policy to come. The Fed tried to raise rates in QT or cut the balance sheet a couple times in recent years. It did throughout 2018 and 2019. That ended catastrophically. Powell tried it in 2022. We had the worst nominal returns in stocks and bonds since 1871. So if they try to go hawkish, it'll destroy the markets. The Fed's real mandate is the markets, not employment and not inflation. They're terrified of inflation, but they don't have the tools they once had under Volcker to raise rates to 18% to fight inflation, because at 38 trillion and counting in public debt, you can't raise rates in a meaningful way without destroying the economy. So the Fed is trapped between a currency rock and a debt hard place. Their tools, their two weapons, rising rates or lowering rates and expanding or tightening the balance sheet, are becoming less and less effective because the debt levels are now past the Rubicon of rational, and they have been for years. And that's why we've seen for years the slow volatility spikes and everything from the repo markets to the bond markets, the treasury auctions. the gilt markets. These are all signs of credit cracks. We saw it in March of 2020. We saw it in the bank failures in 2023. We saw it on Liberation Day in the tariffs in April of 25. We cannot prosecute a trade war. We cannot prosecute an inflation war because our debt won't allow us. And that's the thing, I think, that's the stepping back, take a deep breath, keep it simple. We have too much debt to be effective. And that goes back to your first question. Why are we rattling our swords again? Because we desperately need a distraction, and we desperately need resources we can't afford anymore because we have too much debt. So it's all tied together in my mind, Darrell. And whoever comes into the Fed's office has very few tools left. And yeah, we can win some temporary prosperity by printing another $1 trillion this year, at the expense of the currency. We can buy time. But that just makes our U.S. Treasury that less credible and trustworthy. And that just means that for anyone to buy our U.S. Treasuries, they're going to want higher premiums, higher rates, which we can't afford to give. So we're really at a point now, and I'm not trying to be dramatic, where we don't have many good options left. That's why we're seeing so many problems.
Yeah, definitely. Okay, so let's pivot to silver and gold. So one thing I want to touch on. So there's multiple things happening, right? But one is we have the Comex and the LBMA, and on the Comex, there's these obvious times of illiquidity, where you see these drastic, drops in the silver price. I guess the futures price, right? And then we have the Shanghai Gold Exchange. That reflects the price of per ounce of silver as higher. And so just curious in your perspective there, is this obvious like market manipulation? Is this a mixture of both manipulation and just short traders coming in and shorting the market? But it just looks kind of suspicious when it happens at hours of illiquidity.
Yeah, well, again, these are really important questions. There's in the Comex and in the LBMA market, Comex in New York is unregulated. The LBMA market in London, it's really more, they have different roles, but long story short, they're both highly manipulative of gold and silver prices, and they have been since the early 70s. And there was no coincidence that the Comex added futures contracts to gold and silver in 1973, 2 years after we went up the gold standard. Because when we went off the gold standard in 1971, there was no chaperone for the dollar. We could create as many dollars as we wanted, and that was inflationary. That was dangerous. So we needed demand for those dollars. That's why we created the petrodollar in 1974 to sponge up those dollars, and that's why we added futures contracts to the Comex, because if we're going to inflate the dollar, the biggest antagonist to the dollar, what Volcker and Nixon and everyone, John Connally, was terrified of in the early 70s was the gold price. And so if the gold price rose too high, that was a middle finger to the US dollar, the unchaperoned fiat US dollar post 71. So it was not a coincidence that guys like Leo Malamud and young Alan Greenspan and young Milton Friedman decided to let's add super leverage to precious metals, and let's have 8 bullion banks effectively get up every morning at 8:30 and lever huge paper contracts against, in the short direction, against the gold price, even though there'd be more long contracts in gold by normal buyers, speculators. They would then use these 8 powerful banks to just wake up every morning and put massive boot to the neck on the gold price. That's not a debate, that's not fable, that's fact, in my opinion. The evidence is overwhelming. And for years, the Comex could get away with doing that. They could go 100 to 1, 200 to 1 on paper shorts to keep the gold price and the silver price down dramatically. And that happened for decades. I mean, WikiLeaks, Peter Umbro, these things are not just sensational statements. The data is overwhelming in my mind. I've written about the Comex for 6 or 7 years. And I've also said that at some point, that game, that legalized price manipulation, price fixing of gold and silver in particular, because again, gold and silver are a threat to monetary systems based on fiat paper money. When gold and silver rise, it's a flashing red signal that fiat paper money systems are dying. So there is a need, almost a national security need, to keep gold and silver in check. And in the Comex market in particular, that worked for decades relatively smoothly, as long as there was enough gold and silver in those exchanges that they could lever. What we saw towards the end of 2024 and well into 2025, changes in these markets that were extraordinary. Again, my whole career, Comex has been a net exporter of gold, not a net importer. And for decades, the Comex, less than 1% of gold actually stood for delivery. The game was just keep rolling over the contracts, which were basically for free, just to keep this price fixing going. What we saw this year in 2025, first time in my life, certainly as a trader, when I was a trader, we saw 100% standing for delivery. That for people who understand the Comex is a major headline, but it's meant to be intentionally complex. It's meant to be ignored. Certainly the Wall Street Journal, the Financial Times, or the New York Times aren't going to write a big article on 100% delivery at the Comex because 90% of the readers don't know what that means. They're not supposed to know what that means. But what it means in simple English, and I'm simplifying a lot here, is that the Comex is running out of its gold and silver to play the game of price manipulation. That's a major signal for gold to rip and silver to rip. What we saw in the silver markets in London in October towards the end of 2025 is it simply seized up. There weren't enough silver ounces there to meet delivery. Now they blame that on the size or the weight of silver in the trucks and the truck drivers. Again, that's nothing new. When things are bad, they literally just lie. But you step back and look at all these complications and mechanizations and swaps and derivative contracts and stand for delivery and free floats and all this stuff that everyone's eyes glaze over, and I get it. The simple thing is there's not enough metals on these exchanges to manipulate. And the reason there's not enough metals is that the counterparties want that gold and silver within their own hands now, within their own zip codes, because gold and silver in the next 10 to 15 years are going to be far more important as physical assets than as fodder for leverage on the Comex and LBMA markets. These counterparties want their real strategic reserve asset, gold and silver, more than they want U.S. Treasuries and U.S. dollars for all the reasons we get into. But that U.S. dollar just isn't what it was 50 years ago, 20 years ago, or even 10 years ago, especially since we weaponized that dollar in 2022. The dollar is simply less trusted, less loved, and less in demand in the last 3 years than it was in the last 10 years. And going forward, that chain of distrust is only going to get worse, which means gold and silver in a secular way are only going to get higher in demand. That doesn't mean they don't have pullbacks, and we can talk about that too, but this is not a gold bug case. This is why central banks are stacking it more than they're stacking U.S. Treasuries. They've been net selling U.S. Treasuries since 2014. Net stacking gold in the same amount of time. This year, for the first time since 1997, central banks own more physical gold than they do U.S. Treasuries. That was unthinkable 5 or 10 years ago. You have to step back and ask why. It's because our dollar just isn't trusted anymore. It's too indebted, it's too weaponized, and it's simply not the same dollar it was in 71. And again, that has huge ramifications for precious metals. Great for precious metals owners who are holding it for the long term. Very bad for the rest of the world that relied on the world reserve currency. We're seeing massive changes right now. And I'm not the only one who knows this. You know it, most of your viewers know it, but so do governments. And so probably does dissent in Trump in some way. And that is why we're desperately doing crazy things right now to distract us in these, again, not the end of America, but the end of America as the bully pulpit that can do whatever it wants. Because our currency matters more than people realize. Certainly you feel its debasement on Main Street, but it's not trusted globally. And if the world reserve currency isn't trusted globally, hegemony isn't trusted. And throughout history, you can't have a world reserve currency without a major military. They're interconnected. And now we're using our military muscles as another desperate attempt to try and contain our hegemony or maintain our hegemony. And that's a risky game to play. But going back to your Comex questions, silver and gold can't be manipulated in the same ways. Now, what happened in December with silver is, if you look at the LBMA markets or the Comex markets as like a casino, well, again, their main job is to try and keep gold and silver down because it's embarrassing to the dollar. Well, they don't have silver, for example, to do that. So what did they do? Their next trick was to put, the buy-in on the casino to make the margin cost for silver higher. When you do that on a Friday night at 2 a.m., all the speculators, the shadow bankers, the hedge funds, the VC funds, the speculators, if they don't come up with the margin hike, if they don't pay for that immediately, they're automatically forced to sell. There's literally there are forced sellers. If there's a forced sale of a large amount of silver, that typically pushes the price down. When they tried that in December 12th of 2025, rather than push the silver price down, within a couple of days, the price actually went up. So that's because industrial buyers of silver, whether that's for nuclear power, whether that's for solar panels, or whether that's for Samsung phones, they saw that as a for sale sign. They just bought more of it. In other words, these markets, these exchanges are losing their ability to manipulate. Now, if they keep raising the buy-in or the margin cost, 10% this month, 10% next month, 10% in the month after, they've done that before in 1980, and they could do it again. That could actually force much greater selling. That can create a lot more volatility for the silver price. That's possible. And their most desperate act would be to just make the exchange a sell-only exchange. But if they do that, then the Comex really has shot itself in the foot. Then the question would be, would the SPYMEX or the Shanghai exchanges in Singapore or in Russia, would those exchanges have a fair price for silver and gold? And would the Comex essentially just be shooting itself in the foot, and the world would just turn east to do its exchanges? That's a speculation. That's a question we don't know the answer to. You can't have a 200-day moving average in China that's different than, or St. Petersburg that's different than London or New York. Eventually, the world will pick the fair pricing mechanism, the fair pricing exchange. I don't think St. Petersburg and Shanghai are going to cooperate with London or New York in the current environment, but who knows? But there's just so much chaos right now, Darrell. I know it's wonky stuff, Comex, blah, blah. Bottom line is there's just not enough gold and silver in these exchanges to manipulate the price. And the reason there isn't is countries would rather have that gold now than manipulate the price, because they see the future, the direction of the hockey puck. The hockey puck, as Wayne Gretzky says, is how you play the game. And they see the hockey puck moving away from the dollar. The BRICS certainly see it. Russia and China certainly see it. And the Comex counterparties see it. And that's not a gold bug argument. It's common sense. It's happening right in front of our eyes.
Yeah. Would you say that the difference in this scenarios, which this is kind of what I think. So obviously we had the 1980s, Hunt Brothers and everything, and the Comex changed the rules underneath them. Same thing in the Wall Street silver crowd in 2021. Comex raised, I think they raised margins during that time too.
Yep.
And the commodities futures trading commission chair came out and said, "Oh, we're watching these markets, and we're looking for cracks or looking for dangers or whatnot." And so, I think the CME ended up raising margins at that point. But now, they're raising margins, but you have a lot of industry buyers,
right?
And so,
right.
I mean, 2021, you had more retail. 1980s. Hunt Brothers, I would argue that's more retail than industrial. And so just curious in your perspective on the industrial demand.
It's a key point, Darrell. Again, I think what happened in December, which is very unique now, again, especially with silver, because silver is a monetary metal, but it's different. It's certainly a lot more volatile than gold because it also has industrial use too. And in this case, it's a tailwind for silver. What happened when they tried to raise the buy-in or the margin costs in 2025, unlike say 1980 or even 2020? Like I said, when that did at midnight on the 12th cause a huge sell-off. I don't remember how many ounces. It was a big sell-off, but immediately, because of the industrial demand for silver, there was a lot of buy orders from Samsung and other companies or Tesla to buy that silver on sale. And then immediately the price actually went up within 3 days of the margin hike, which is really unique. And I think to your point, the reason that gap was filled so easily, that demand gap was filled so easily, despite the sell-off on the night of the margin hike, is because of that industrial demand. There's only a certain amount of fixed supply for silver. It's a fixed supply. Its market cap is half of NVIDIA. So when it's turned into a control panel or a solar panel or a Samsung panel, it's gone. It's off the market. There is a fixed supply. So when they see an attempt by the LBMA or the Comex exchanges to manipulate the price down, they're going to see that as a discount sale. They're going to buy in those moments because of that industrial demand, which is so much higher now. And also it's monetary demand. But, does that mean that the LBMA markets or these Comex and these other exchanges are going to give up on manipulating? No. And if they do raise these margins consistently higher in the months ahead, that could certainly have an impact. Silver is a lot more volatile than gold. As Egon says, it's not for widows and orphans for a reason. We certainly saw it peak in 1980 to, and then it dropped from 50 to 20 to 5 for decades. You got to look at that a little more carefully. But that's at the same time, though, I think given the massive shifts in geopolitics and the industrial demand for silver in particular, yes, it's more volatile, but I still think it has a tremendous amount of tailwind. I think the real way to measure the risk in silver isn't to look at the dollar price or the paper money price, whatever it's Australian, Canadian, or American dollar, or euros, or yen, or Swiss francs. It's really looking at the compressions, the spreads, the gold-silver ratios. At what point do you, as an individual silver investor, want to take your profits? I think there's a heck of a lot more space for silver to run, but it's certainly more volatile than gold. You have to look at it a little more differently. But to say that the manipulation is over, I think, is naive. There's still other tricks, margin hikes, and possibly a sell-only market. That's possible. We're all speculating now. But in the long run, precious metals will continue to rise only because the global monetary system, the things we talked about at the beginning, are continuing to deteriorate. And so if you're a trader, you have to be much more careful. If you're a longer-term investor, especially in gold, you're not too fazed by these swings. But even if you're a longer-term investor in silver, we do know that, in bull markets, silver can shake a lot of people out on the way up. And that's typical of bull markets, to try and shake as many off on the way up. And few who will ride it all the way to the peak. And many will say you're at peak silver, you should jump into Bitcoin or something like that. Silver's much more volatile. It's kind of like the NASDAQ versus the Dow. Gold versus silver are much more volatile. So you have to be a little more careful on what your exits are for silver. If you're a long-term investor, you still have to be more careful. There is a point. I don't think we're near the top for silver for a number of reasons. For gold, it's very different. Gold's only in a bull market because paper currencies are in an obvious, not just a bear cycle. They're at the end of an order. They're at the end of an era. And that, again, I think is objectively obvious. That's scary. That's actually scary.
Yeah, for sure. Yeah, I'm curious in your perspective on how this can run. So there's multiple, experts, that look at the charts and they say, hey, silver's going to triple digits. Not too long ago, I was in my local coin shop and was talking to my coin dealer. We built this friendship, and we talk about the miners and everything, and so it's pretty cool. But he came in, he said, hey, there's this guy going around buying millions of dollars in silver, and he bought out my whole bottom shelf. He went to some of these other coin shops, bought them out and such, and he says that silver is going to $500 in the next few months. And so, and you just mentioned, like, okay, silver can shake some people out, like it can have a volatile swing. You look at the 2008 to 2011. Silver went from what I forgot what price it crashed down to. I think it was
went
pretty
50
bad.
to 20 to 5 and stayed there for a long time. It was brutal.
And so curious in your perspective on, folks are excited, but are folks getting ahead of themselves and being a little too bullish,
Well, again, I think there's a lot of clickbait out there. There's even that Asian AI guy going around, and 80% of it is accurate, 20% is completely nonsensical numbers. Again, in pricing silver or gold, for that matter, in a fiat currency, I think in comparing that for your exits is more dangerous. I'm not a trader anymore, so I'm not helpful to people looking to trade or get in and out. I'm not helpful in saying I think silver's going to 600 to get quick hits, because I don't look at it that way anymore. I look at it. I look at gold in particular as a monetary metal, silver also, and I look at central bank stacking of gold as a real demand source. I think the retail side's only going to double and triple very soon. The average gold holder is 0.5% for allocations. It should. Well, recently it's getting to 1%. It can get to as high as 4 or 6%. I think that's coming. The combination of retail and central bank gold stacking, to me, is an obvious tailwind. But even if it weren't there, I know that gold holds its value better than paper money. So I'm in it for decades. With silver, to your question, how do you know? Will it go to 500? Will it go to 300? Will it go to 250? In inflation-adjusted terms, it hasn't even reached its high yet, in my opinion. So I think silver has, my personal opinion is silver has much higher to go. Will I say 500, 600? That's irrelevant. I look at to me at least, I look at the gold-silver ratios. We saw them as low as 15 and 32 in 1980 and 2011. So, you pick your own ratio based on your own profile, your own opinion. For me to say, I say gold is at 600, I think is a fool's game. It's a mug's game to say that out loud because no one really knows. What I do feel with conviction is that silver has much higher to go, but very few people will pick the top. Very few people I know who trade precious metals do it well. Even the ones I interview with who are traders of the metal, I've watched their signals for years. They've gotten it wrong many times if you're trading. I think if you're holding it for the longer term, gold's a no-brainer. Silver is different. You do have to pick your compression, your ratio that you think you're comfortable with. I know guys who bought silver at 20, they're still in it to win it. They'll probably go much higher, but even they at some point have to look at the volatility of silver and say, this is my sell point. At what ratio do I sell? Not at what dollar price, because that's measuring it with an ice cube. It's measuring like your weight on a broken scale. I don't measure it in fiat. How many barrels of oil, how much real estate, et cetera, can you buy with that silver? That's a very personal decision. But to your key point, what do I price predict? I never price predict metals. I just say they're going to go meaningfully higher. For gold, I still think that's a much longer term trade for gold. Silver will go meaningfully higher, but not without volatility. If you're a big boy or girl and you're in it for the long run, you have to pick your ratio, your gold-silver ratio, and sell at that and be consistent, because you'll never pick the top. If you're a trader, I don't have any advice for you, because I'm not a trader in it. And I don't know many even professional traders who do it well. So I think that's a much riskier game. I'm not trying to avoid the question. Nobody can, with a straight face, give you that answer. But I do think with a straight face, silver will go meaningfully higher, but it can shake a lot of people out on the way. Even gold, in its major gold run from 71 to 80, when it went from 35 to over $800 in that 10-year period, midway through that bull run in 1975, saw a real uh-oh moment in the gold price. That shook a lot of people out. But again, if you step back and look at gold in particular as a monetary metal in a monetary system that's dying, gold's price moves isn't a speculation trade like NVIDIA or the NASDAQ or an index. Gold's price moves in 2025 and going forward are much more serious and much more terrifying, because it's not about a bull run in a metal. It's about a system falling to its knees right in front of us, a monetary system. This is much different than a typical bull market. And again, it's not the gold camp that's saying this anymore. It's not executives in Switzerland with a hole in the ground that charges money to store it. Egon von Greyer saw this 30 years ago. It's culminating now. And I think it's culminating for all the wrong reasons. The reasons we've predicted, sadly, are coming true, that debt has taken our currency and made it into a beautiful ice cube that's melting right in front of us. Purchasing power is dying. Governments are losing leverage, and they're getting desperate. But the financial system based on paper money is no longer trusted. You don't have to be a fan of the BRICS or China or Russia, but they saw this coming. They're playing chess. We're playing checkers. We're using wordsmithing, politics, BCom, carry on, all the Doge, the USAID, tariffs, whatever, executive motion left or right, Republican or Democrat, I don't care anymore. No one can save a system this far in debt with more debt. You cannot solve a debt crisis with more debt and then pay for that debt with money muscles out of nowhere without destroying the currency. We got away with it for decades. We're hitting that point of reckoning. It's happening slowly but surely. It's death by 1,000 cuts. But like Hemingway also described poverty, it happens slowly then all at once. People don't want to see America, that America could ever do that as the home of the world reserve currency. I say it's Marilyn Monroe, Clark Gable, the Yankees, the Red Sox, the flag on Iwo Jima, all the things that America, iconic America, is great for, all the things that I'm proud about America. It isn't the same America anymore. God, doesn't mean the end of it. It's a dramatic change. And that's why gold's going to continue to go north, not in a straight line. It will shake people out. But if you look at gold as a strategic reserve asset, which is what even the BIS is saying, you need to hold that more than dollars. You need to save in gold and spend in fiat. That's what the central banks are doing. That's what the BIS is doing. Even Morgan Stanley, which was no fan of gold for decades, can't deny from their own clients that they're making a 20% allocation to gold instead of bonds because they're a better store of value. So again, I didn't make this up. The BIS did. The Comex is telling you this. The BRICS are telling you this. The petrodollar is telling you this. These are not things that we should be shrugging off. These are major signals. Again, not the end of the world, but a massively changing world, and certainly the end of the dollar as the dominant, safe store of value. It's my strong opinion. And again, I think the evidence at every level is pretty compelling for that.
Yeah. So for me, full transparency, I'm still buying gold. I started buying gold in 2020, and so buying gold at these levels. It's a little, I kind of feel a little pain, buying it. It's like dang, but I just don't feel like I own enough, right?
Right.
And over a 10-year outlook, I'm like, okay, gold could be, $8,000, $10,000, or whatnot, and I would have preserved that much purchasing power.
Mm-hmm.
And so, just curious, you know, uh, in your perspective. I mean, obviously, you got folks that are new coming into the space and
Right.
that are starting at zero,
Right.
and they're like, okay, let me buy something, and they have to buy at these levels. But then you have some folks that have been in the space, a lot longer, and they're like, yeah, I'm not adding to my position now. Do you view it as something that you're just going to continuously buy? I mean, because when you think of gold as money, right,
Mm-hmm.
it's like,
Mm-hmm.
okay, well, you just want to keep saving in gold. And I'm just curious if you're buying at these levels, or what's your thoughts there?
Yeah, again, important question. I want to answer it directly, and there's 4 or 5 different ways to answer it. But again, if you're looking at gold as a strategic reserve asset, as a better store of value than any currency, whether that's a franc, a euro, a dollar, Australian, etc., or a yen or a peso, you want to have as much gold as you can reasonably afford, because it will hold its purchasing power longer than any fiat dollar or franc or euro that you own in the long term. If you're a long-term holder, I can say with a fairly strong amount of confidence that whatever you buy it at, it's going to be worth a lot more 10 or 15 years now today than it is. Than it is today. But I've had, I spend more time talking to clients than I do doing interviews, and I've been doing this for years. And I've certainly, myself included, have talked to clients who thought 1,800 was too expensive. We're at a top. And again, it's not a stupid question when gold's at 1,800 or 1,600. Am I buying at a top, Matt? I just don't know. And I would always say, I don't know where the gold price is going to be in 4 months. I think it's going to be meaningfully higher over the next 20 years, because look at our paper money. So for anyone asking this question, am I buying at a top? If I buy today and there's a 30% pullback, I'm going to be really upset. And there are a lot of guys like Henrik Zeberg that I debated with who have a strong case that you could see a major pullback in gold if the markets mean revert. So they're going to wait for that 30% pullback to buy their gold, or even 40% pullback, which we saw in 75. That's fine if you're trying to time your entry. The problem is a pullback of 30% from what price? From 4,400 or 5,400 or 6,200? If you keep waiting for the pullback, none of us can time it, then you're still maybe paying more even then than you would be today. I don't know. But if I'm holding gold for 15 or 20 years for my grandkids and their kids and for my savings, I just wanted to get as much as I can afford, because I'm not trying to trade it. Obviously, I would have rather bought it at 1,800 than 4,400, of course. And I did, because I've had a far-sighted view. But if you're coming into the markets now and you don't own an ounce of gold, I respect that it's a tough question, because it could be pullback. No one can time it. But again, what would that pullback be? I was in a big debate with Henrik Zeberg in South Africa at the beginning of the year. Gold was at 2,800, and there was talk of a 30% pullback. So nobody bought their gold then, because they're waiting for the pullback. At the end of the year, it's at 4,400. If we had a 30% pullback at the end of the year, it'd still be cheaper to have bought in at 2,800. In other words, it's very hard to time. And if you're a trader, good luck. If you're an investor, I know it feels like you're probably buying at a top. But I think 10 years from now, I don't think you'll be so worried about it if you're holding it for the long term. That doesn't mean, and Rick Rule would agree with this too, it doesn't mean that gold in a secular bull market will not have major price moves and going south. It will scare some people out. If you understand the real reason for owning gold as a preservation asset, which is what Egon von Greyerz has been doing for 30 years, who bought gold, by the way, at a meaningful level at $300, far cheaper than I ever bought it at. I've known Egon for 7 years. We have never sat down and talked about the gold price. He's never gloated about it. He's never cared about it. He's been in this business when I was still trading stocks and bonds, when gold was flat for years. And he built his business when gold was flat for years, because it didn't matter to him, the daily price move. He just knew over the next 50 years, 60 years, that gold will hold its value better than paper money. That is our strong belief, as gold's a preservation asset. So again, I know it, and I know an ounce of gold for many listeners is just unaffordable. So then get grams of gold. And then there's the poor man's gold silver. I think it's a smart man's silver. So buy some silver, it's more affordable. Even that's becoming less affordable. And silver is volatile, so it is scary. But if you're holding it for many, many years and you have some compression awareness and the ratio awareness, you'll know when to get out of silver. Certainly would have rather bought it at 40 than 80. But that doesn't mean gold can't go to, or silver, can't go to 150, 200, 250, 300. I think there's a strong case for that. You've got to decide at what point is a profit good enough for you in silver, and then I would take that profit and use it to buy more gold as a long-term steady preservation asset, which is exactly what the central banks are doing anyway. It's what high net worth investors and family offices are doing. What's sad is a lot of the folks on Main Street who haven't been following gold or thought it was a pet rock or a pawn shop asset or too volatile, even though it outperformed the markets for 25 years, who've been told by the industrial complex, RIA industrial complex, that gold was a pet rock and that Bitcoin would save them. You know, it's not too late to still get a meaningful percentage of gold that you can afford. But I do respect that for many listeners, it seems like they missed the boat. But even at these prices, if you can afford parts of it, half an ounce, grams of it, and you're looking to build over 20 years, just keep dollar cost averaging in, because it will save the purchasing power of your wealth better than a checking account with US or Canadian or Australian dollars. That's what I think. That's what a lot of us who are long-term investors in gold think. And I realize I'm an executive out of Switzerland selling gold and silver. There's clearly a bias. Piepenburg selling his book. But Egon, myself, Rick Rule, all of us, I think, have high conviction. You know, Andy Schechtman, anyone who's been in this business for decades, rather than the Johnny-come-latelys who've jumped in the last 12 months in the space, and they're all over the internet now. We've always said it's not a trade. It's a preservation asset. You got to be thinking years and years out. And I think years and years out, even if you bought it to the most recent gold high, it'll hold its value better than the dollars you bought it with. And I think that's the key thing to focus on.
Yeah, for sure. And so lastly, when we look at the central banks buying gold and them owning more gold than treasuries, I mean, you look at that chart and how it's flipped. So in the 70s, central banks owned a lot more gold than they did U.S. treasuries.
Yep.
Right. And then we see that when interest rates rose and, pretty much breaking the inflation under Volcker and such, you begin to see that trend change to where central banks started selling their gold for treasuries.
Sure.
So now it seems like we're still early in the central banks actually flipping their ownership of treasuries versus gold. And so I was just kind of curious, and it seems like gold could go a lot higher in that scenario, especially if it gets to levels where they were in the past.
That's a very good point. I mean, look at the 70s and look at today, and it's important to see the difference. In 1970s, our public debt in the U.S. was less than half, what, 500 billion, okay? Or 250 billion when the year I was born. And so, yes, Volcker could raise rates to 18, 19%, and that was a viable possibility for him. And if you raise rates, gold, which gives you no yield, if you're getting 18%, or you're getting much better yield on a treasury, you're getting positive real yields. That's always been a headwind for gold. And in the 70s, when Powell was raising rates, you can get better yield on a treasury. There was an obvious desire to dump gold and buy treasuries. The world was buying treasuries. We couldn't even get OPEC or Saudi Arabia to do a petrodollar until we raised rates meaningful, because then they realized, well, the dollar is strong, rates are good. We bribed OPEC. Kissinger got OPEC and got Saudi Arabia to make it a dollar-based energy petrodollar, because we were able to raise rates and seduce them in. We forced them in, but we seduced them with raising rates. The problem is, fast forward 50 plus years to today, you will never see the Fed raising rates to 18%. They cannot afford it at 38 trillion in public debt. Billion versus a trillion is a major thing. Remember, a billion seconds ago was 1997. A trillion seconds ago was 30,000 BC. So the difference between a billion and a trillion is massive. And when we had 250 billion in debt in the 70s to 38 trillion today, we can't raise rates to make our treasury sexy. We can't afford a higher costing or higher yielding treasury to make our bonds more sexy, because we can't pay the interest alone on those IOUs. So we are not in a situation like the 70s. Central banks can't be selling, they're stacking. Gordon Brown sold all of England's gold in 1980 at like $250 or something, before 1980. I mean, that he should be held as a criminal to what he did to England, because now housewives in India own more gold than the Bank of England at a time when the world wants gold more than paper money. But he thought, gold bugs, gold market, done, we're out, the dollar's king, we're in bed with the US, we'll be fine, this is great. What Gordon Brown did to England is a criminal negligence. And that's why Germany and France came to the harbors with their boats and got their physical gold out of these exchanges long ago, because they were thinking 5 steps ahead rather than 1 week ahead. I feel sorry for sovereign nations that are not, gold rich, because the world is turning, as the BIS is turning, as the BRICS are turning, towards a better reserve asset than a USIOU and a US dollar. And again, that doesn't mean that the U.S. is going to give up easily or that it's the end of the world reserve currency. It's just going to mean a repricing of that currency at a dramatic level. And I've debated for years about a stronger dollar, weaker dollar. There's a strong case for a stronger dollar, a temporary bump in the DXY. If markets crash, will the world go back to U.S. Treasuries and U.S. dollars? There's compelling arguments to be made there. I'm not saying the DXY is going to 10. I just don't think it's going to go 150. But longer term, whether we have a great reset or a Bretton Woods 2.0 or whatever dysfunctional policy or Plaza Accord 2.0 we have when the dollar really pukes, gold's going to be a part of that. Even the IMF during the COVID hysteria, it had to confess that for a digital bank central currency, which I hate, but is inevitable, even for a central bank digital currency, it has to be backed in a meaningful coverage ratio by gold to have any credibility. So again, there's all these signs that gold is the future in some meaningful way. And the countries that have dumped their gold in the 70s really wish they had it today, in particular Great Britain. But that's why Poland, India, Russia, China, all these countries are stacking gold at radical levels. It's not just a trade for them. It's like I said, when you see an army camping out across the river with the flags and the cannons and the horses, you got to know there's something coming. If you see nations and central banks stacking gold in 24, 23, 25, it's not because they're planning to go to war, although it could be war. It's because they're planning to see a currency change. They're stacking their ammunition before the first shots are fired. They're stacking their gold before the dollar can no longer save them. And I think it's just, again, like Wayne Gretzky says, play the hockey puck direction, be patient. That's our strong conviction. Egon's had it since 1999, 2000. I put a meaningful amount into gold. He's never bragged about his price appreciation, which has been extraordinary, because he's still just rather save in gold than Swiss francs or euros or dollars. And he's not alone. And but again, please don't think that gold and silver only go up and to the right for the next 20 years. But they will hold their value better than any currency you measure your wealth in today. And that's the key takeaway I'd like to leave.
Well, appreciate you for coming on the show, Matthew. So you're going to be at VRIC and everything. Looking forward to hearing you speak. Audience, if you have not gotten your tickets to come to the Vancouver Resource Investment Conference, please click the link that's pinned in the comments below. It will also be live streamed on this channel if you're unable to make it up to Vancouver, Canada. So you can hear myself, you can hear Matthew, you can hear Rick Rule, you can hear many others speak on these topics that we've discussed today. And even in more depth, I will argue that when you go to the conferences, you're kind of getting a little more exclusive content. And so that's always been my experience. Is that your experience too, Matthew?
Yeah, I mean, look, I have just as much fun. And I'm a speaker, but I listen to a lot of the presentations there. It's such a great group that Jay puts together every year. And I learn just as much as anyone else there. It's really, really a great conference. So looking forward to it.
Yes, indeed. Yes, indeed. Well, appreciate you for coming on the show, you all, and be sure to click the link that's pinned in the comments. Thank you, Matthew.
All right, Dale. Talk soon.